Hello, everyone. Welcome to Fundamentals Unfiltered. I am Matt with the Fundamental Investing Institute. We are recording this on the week of September 8th, 2025. We've had a relatively slow week in the news, which is not such a bad thing. Relatively weak jobs report, which is almost guaranteeing that the Federal Reserve is going to cut interest rates. They are meeting, the FOMC is meeting in a little over a week. There is some talk now about a 50 basis point cut, or 0.5% rather than 0.25%. Other than that, not a big news week. There is this news about Elon Musk's pay package, which is grabbing a lot of headlines. But if you look at the fine print, Tesla has to become like an $8 trillion market cap company in a handful of years. I really doubt that is going to happen. But in any event, Elon Musk possibly becoming the first trillionaire is certainly grabbing a lot of headlines. The only other thing, I guess, news-wise, is I was watching an interview with Kenneth Rogoff, and I'm actually in the process of reading his most recent book. It's called Our Dollar, Your Problem. I've not finished it yet, but I will talk about that more another time. But Ken Rogoff is the former chief economist of the International Monetary Fund. He's an expert on international finance, a Harvard economist, and he's someone who became kind of a household name, or at least a household name among serious investors and people in the finance world. Back in 2009, he wrote a book called This Time is Different. He co-authored it, rather, with another economist named Carmen Reigart. But the book This Time is Different profiled a lot of historical financial crises. And I saw him in this interview over the weekend. I think he was being interviewed by Anthony Scaramucci, but he's given a lot of interviews, and he's more or less said the same thing. He's predicting a debt crisis in the next 5 years, a sovereign debt crisis, simply because of the amount of treasury debt and sovereign debt from industrialized countries that are coming onto the market. We're starting to see the bond market react a little bit on long-term bond yields, not only in the United States, but in other industrialized countries. So that was a sobering interview that I listened to. Possible debt crisis in the next 5 years. Neither party in the U.S. seems to want to do much about it, so it's just something that, I pay a lot of attention to macroeconomic risks. It's just something that we kind of have to incorporate and think about. But the other thing I was doing a little bit over the weekend, I don't know how I came across this, but something came across my feed about SMB investing. SMB just means small to medium-sized businesses. And there are a lot of influencers in this space who are talking about how great it is to, buy a company, use leverage, install an operator, and it, like most things, optimism sells. So they talk about the economics of these things, and the economics can be very attractive. So I thought I'd talk mostly about that today because it was just something I've thought a lot about over the weekend. And when we look at these deals, I've been involved in a lot of small businesses myself as a fractional owner, some leverage purchases. Really, I think what gets marginalized by a lot of these influencers is the operating challenges, and also the risk of the debt that's involved. And I think some of these influencers talk about using seller notes, almost entirely seller notes. I don't think that's realistic. I don't think most sellers, if it's a good business, a solid established business, I don't think most sellers are going to be overly thrilled about holding a 100% note. They might hold a portion of it. But I was just playing around with some numbers, and I looked at a scenario with a company that was generating 300,000 in discretionary cash flow. And when I say discretionary cash flow, I mean the cash flow that can be distributed out of the business. That's different than a lot of the metrics that you hear in the small business investing world, where you get like seller discretionary earnings or EBITDA. That's earnings before interest, taxes, depreciation, and amortization, or you sometimes hear owner benefit. That's not necessarily true cash flow, because it doesn't account for the cost of paying someone to operate the business, and it could leave out some other things. So I'm talking about true discretionary cash flow. So if you had a company that was generating 300,000 in true discretionary cash flow, if you were paying 5x for that company, you factor in some closing costs associated with the debt, and I assume that you were financing 90% of the purchase price, 10-year amortization, 9% interest rate. We also assumed that the cash was just being accumulated into surplus. It was not being reinvested. And even under that scenario, that base case scenario, the compound rate of return was over 47%. So you can see why these deals are so attractive and why people do them. But I want to talk a little bit about the challenges that I think are involved here. And like I said, that's a relatively conservative scenario. It's what I would call a base case. Now, one thing to consider is the use of debt. In my example, I used 90% of the purchase price. The out of pocket, so the upfront investment was a little over 150, like 154,000, something like that, which was the actual out of pocket investment. And when you do the math, I said it was a 47% plus return. That's a 5-year return. So there's still debt outstanding at the end of those 5 years, but a lot of that debt has been paid down. You also have a cash surplus. So when you look at that equity value, and we're assuming that the value of the business stays the same, when you look at that equity value over 5 years relative to the upfront investment of about 154, that investment compounded at over 47%. So the returns on this are huge, and so you could see why a lot of people, would do this and find them attractive relative to putting money in the market or putting money into commercial real estate. I have some friends in the real estate world. I've showed them these numbers, and they're to say that they salivate is an understatement. I mean, they're great numbers, but if you look at that same scenario and you take debt out of the equation, the returns compounded at about 15% over those 5 years. So a lot of those returns are coming from the debt load, and of course leverage works both ways. It can magnify returns and it can magnify losses. There are a lot of horror stories, and I'm intimately familiar with a few. Luckily I've avoided that myself, but there are a lot of horror stories of people taking out a lot of borrowed money, 7 figures of borrowed money to do an acquisition, and they end up getting wiped out. Things, the business declines, the industry declines, we go into a deep recession, whatever. And with with bank loans, whether SBA loans or other kind of conventional bank loans, the borrower's on the hook. That's a full recourse loan. They're personally guaranteeing that loan. So to the extent that a lot of the acquisition is goodwill, which is just an intangible asset, if those deals go south, you're on the hook. So those are very attractive returns come at a cost. Now, a couple of things to think about too, and of course, what a lot of the influencers talk about is how to creatively finance these things, and they always, as I mentioned earlier, they're always talking about seller financing. Again, I don't see seller financing as being feasible for anything more than a portion of the purchase price. But that's what a lot of these influencers talk about, regardless of how they're financed. And again, these things really don't work all that well unless there's a lot of borrowed money. I mean, they're still attractive, but not nearly as attractive. So a few other major issues I want to talk about with regards to investing in small businesses. One is that they're really hard to find. They're really hard to find companies that are generating true discretionary cash flow. So if you go on Biz Buy Sell or you go on LoopNet, what you're going to find is a lot of small businesses they're essentially just jobs. In other words, they're providing a living for the people operating them, but really not producing any discretionary cash flow. So those businesses are fine if someone is looking to buy them to operate them, but they are not really good investments. So, and that's what I'm talking about is the scenarios in which someone can put up the equity, take risk on the debt, and install an operator. Because that's what I think a lot of these influencers are talking about. They're not just talking about entrepreneurship through acquisition, which is a different animal. And if you go on these listing sites, LoopNet and BizNet, you're going to find very few of them. And what's happening, I think, increasingly is that private equity firms are backing a lot of acquisition vehicles. So a lot of the good businesses are just being scooped up off market. And, there are still interesting opportunities, I think, that pop up on the listing sites, but they are becoming increasingly rare. And then, talked about the leverage, talked about the risk of the leverage. And then, the third thing, and I think the biggest issue, is how hard it is to find great operators. And I would argue with the SMB world, you're really not investing in businesses. I think you're investing in operators. And I personally have grown increasingly indifferent to buying versus building a business, because the key to success in both is having a great operator in place. Right? And if I can find a great operator, I would be more than happy to put up the finances to start something from the ground up. The problem is finding those operators that have the rare combination of leadership ability, sales and marketing training. They know how to build cultures. They understand at least basic financial accounting and financial management. I mean, good operators and certainly great operators are really hard to find. And because they're hard to find and because they're in so much demand, they command a premium. So if you're looking to buy a company, especially using leverage, and you want to install an operator, you're going to have to be prepared to give up a lot of the upside to that operator. Now, I think they're worth every penny, and I think these deals are lucrative enough to where somebody can do that. But it's something that, I don't think gets talked about enough, because I'm not sure if I trust myself to find great operators just through traditional channels like, putting something out on Indeed or something like that. Now, granted, you do have search firms that are coming up that kind of specialize in finding SMB operators, and that's one of the big changes that's happened in the last few years. But for the most part, that's still very, very rare. And like I said, if you have a great operator, I think the economics of an acquisition are much more comparable to the economics of a startup, especially for a lot of the mainstream businesses that we're talking about. Most of the businesses that I've seen listed, there are very few of them, even the ones that financially are attractive, that financially They can be used to support debt. Those type of businesses, very few of them could not be built from the ground up and replicated within a few years if you have a great operator in place, and that's the key. And you have to think about it too. With a lot of these small businesses that you're buying, you have an owner operator that's stepping down, and when that happens, you end up with key employees often leaving, key customers often leaving. There's a huge cultural shock that happens. People just don't like change. And if you have an incompetent or inexperienced operator in place, those deals can break down very quickly, especially given the debt load. So that's the real key, and that's what I wanted to address. Is I'm seeing these influencers come out and talk about how great these things are, and certainly there are plenty of people who pull it off. But it's a lot more work, and there are a lot more challenges involved than what they let on. And I should say, in the interest of disclosure, I've had fractional ownership in a lot of businesses, but at the moment, with the exception of my business, trying to get the Fundamental Investing Institute further off the ground, all of my investment resources are in public markets at the moment. I have no, actually, I shouldn't say that. We have a little bit into private credit markets, but I don't have any fractional ownership in small businesses right now. I'm kind of taking a break. We'll dive in at some point, and the reason is the time involved. It's far more time than people sort of let on. So I'm just saying that as you come across these things from a lot of different influencers, people talking about this online, different social media spots and so forth, that they generally seem to minimize the challenges that's involved. And like I said, optimism sells. That's why investment brokerages issue far more buy recommendations than sell recommendations, right? Because optimism is just a better sales point than pessimism. So it's just something to keep in mind from someone who's been there. The challenges here are far more than they let on. We never want to minimize the risk of borrowed money, which can work both ways. We certainly don't want to minimize the challenges of actually finding these deals. I know that some of the acquisition platforms that I've worked with in the past, I mean, they had people looking for deals full time, and usually doing national searches, so it can be hard to compete. It's a little bit like, I think, with residential investing. I know people who have buy like fix and flip or single family rentals. When that became much more institutionalized after the financial crisis, I think it became harder for independent operators. Maybe that's changing a little bit in the current housing downturn, but it was certainly the case for a long time. And that's the case here. Is you have a lot of institutional money, and so for independent investors, it'd be kind of hard to compete. It's still a place that's worth looking if you have a network of great operators that can come in there. But it's not a passive investment in a traditional sense. I mean, even if you're buying it and installing an operator, you're still going to have to be involved at the board level. You're still going to be putting your name on, credit accounts with suppliers and possibly, lenders if you are using borrowed money. So it really shouldn't be thought of in the same way as a purely passive investment. It's more of maybe what we would call an entrepreneurial investment. We'll go with that. But like I said, I just wanted to elaborate on that point. It was something I've been thinking about over the weekend. Like I said, I can't even remember exactly what I came across, but there's a lot of stuff that comes into my feeds about small business investing because it's just something that's taken off on social media with a lot of people. So I will leave anyone who is interested in this field with a great resource that I follow. It's a podcast called Acquiring Minds, and it's hosted by a guy named Will Smith, not the actor, different Will Smith, but he what he does is he interviews people who have acquired businesses, mostly independent operators. Sometimes he has some private equity backed sponsors that are acquiring businesses and doing it at scale. But for the most part, these are mainstream businesses, plumbing companies, different home service businesses, professional services, etc. And he interviews the people. And to his credit, he occasionally interviews people who have had, some not so good experiences. People who have taken out a lot of money and ended up going under. And I think it's important to talk about those as well. Certainly plenty of successful deals that he profiles, but it's a great resource. It's called Acquiring Minds. It's a podcast. I don't listen to it all the time, but as far as resources, I think that's one of the better ones. And with that said, I hope everyone has a great week, and wish everyone a lot of successful investing. As always, focus on the fundamentals. If you can hit like and subscribe, we will try to get more of these out. And as I said before, one of my goals is I want to do start doing a lecture series on financial history, which is something that I incorporate a lot into my own thinking, and that will be forthcoming. But in the meantime, have a great week, everybody.